Okay, everybody, 10:45 p.m. I've only been up since 6 a.m., so it's been a long day. On March 15th, I sent out this newsletter, and there it is there. And that was the thumbnail for it when I had planned to have a live broadcast on the 17th. And, you've got the stamp there. I was not feeling well. The original thumbnail is that complacency kills. And I'm going to quickly go through the bullet points now on what I intended at that time. And of course, this is the thing that is great about the internet, of course, right? Which is that we have date and time stamps here. And when I had sent this, and the reason for sending it is right here, which is that AI stocks are distorting stuff. And by distorting stuff, what I mean is due to the way that indices are reported, there are weightings. And NVIDIA, ARM, kind of taking their two separate indices on their own path. And NVIDIA is not alone. Microsoft, the Magnificent Seven, Facebook, certainly. And so what ended up happening is that you're reported as if the stock market is flying and everything in the world is hunky-dory. For me, the issue is, okay, why don't we think about it in a different way, which is, let's just say, okay, well, this is just us, and, back to my favorite diagrams, right, which is that we just happen to be in this area where this is not just normal, but, average at all. This is not what I would have said is average, but rather way above average. Now, when that happens in your favor, it is easy to be complacent. I get that, right? You look at your balance, it's higher, hooray. And then you feel better and you go to the store. It's like, okay, Cheerios are still $7. Well, I have more money because my statement said so. The issue is, of course, is that your bank balance, your brokerage account balance, IRA balance is not redeemable at that price. It is only redeemable after you sell and then are taxed and then get out the money. And only then can you then, redeem it for Cheerios. At that time, and like I said, date and time stamp here, right on the 15th, I was like saying, these indices are so distorted that we should take a look and see. And I was trying to explain that distortion. And the reason for doing so is, of course, there's the other side of the distribution here, which is that in a world of randomness where we are not in control or have a crystal ball, we are dealing with the prices as given, right? Your stockbroker is not going to be influencing the price of Google, I promise. No one is calling your broker to say, what do you think about Google and its price here and where is it going? That is not, of course. And that seems like, crazily obvious, but it's very important to keep this in mind because when it's going well, it's at least worth the look, a squint. Take a careful look. Because now you've got a windfall sitting in there somewhere. And then the question is, okay, well, how are you going to fit it into Mr. X? Right? How are you going to, and that tells you where the futures markets are. Where are you going to fit it in here? Because certainly the balances in this violet have gone higher. You can see it. Right? I didn't say in real terms that, right? I did not say this is the number of boxes of Cheerios here. These are just nominal terms, balances. My point here is that it doesn't really help you unless they are converted into this money, right? Which can be converted into post-tax cash so that you can meet your expenses. That's what this is for, right? That's the function. Now, don't get me wrong. Other people have different objectives, right? They want to pass They want to try to hit a home run because you're trying to buy 20 islands. That is different. Okay, that is different. But these are the basics here on what you're trying to accomplish. And we've got all of these different spots, and you can see different inputs into, where you can get money on a post-tax basis in order to create cash to pay for Cheerios. The issue here is that, okay, that's fine for those people with many layers. Maybe you're currently working, you have big Social Security for retire and PIAs. Maybe you have traditional income, etc. I've gone through a lot of explanations about how, for example, these other structures work. That explains why I'm part of the Alliance for Lifetime Income, because of the fact this is a very important way, not the only, but it's an important way where the value, which had gone up down here, can be converted into reasonable, repeatable, guaranteed numbers here. Okay. So that is the reason that I created this schedule or had this plan here, which is to talk about, hey, just because your numbers look higher when you go onto your website, your brokerage website, that's precisely the time to be squinting. And that is more true for people who are concerned about running out of money. It is less true for people at different age divisions or people whose excess balances are so high that they can take the volatility. And who are you? Well, let's just say, for example, your balances are super big, right? If you have $10 million, for example, you're not really affected. Of course not. That doesn't make, I promise you, the people with $10 million are not calling me happy, right? With the volatility in the market. That is different, right? But the objective fact is that they're still going to have money to pay bills. That's just the objective fact. If you have a 30-year-old child, the reality is, and let's just say a 30-year-old child who makes, gobs of money compared to their peer group. The reality is, when they're coming to me and ask me, okay, give me the bullet points, I'm saying, you want it way down. We need better entry points. We need better entry points with bigger amounts of money at those lower entry points. You don't want the markets here. They're welcoming volatility, is the reality. Why? Because they have time. Time, right? They have time to be wrong so that they can add. So that when ultimately over very long time periods, there will be a chance, right? More likely scenarios where there are more different junctures to be higher. That said, of course, that you might say could fly in the face of, Jay, I thought you said it's random and we are always at the red arrow. That is true. The point is that we know that you're going to be wrong, right? Presume that you don't have a crystal ball. And if you're running in a disciplined way, then yes, of course, for the people who have spare cash, they want it lower. Why? So that they can add. They're not going away from volatility. They want the volatility. I've told this many, many times to our clients who are very well off. I'm like, look, the reality is that these prices, and given what's gone on in markets, well, you want lower. You don't want higher. And of course, this is the age-old story, right? This is why if you go to an emerging markets country, why you think that there's wage disparity or wealth disparity in the United States. That's not anything compared to emerging markets. Why? Because there are a huge number of people where the money has to go to food. So the baby gets thrown out with the bathwater, right? And the baby gets put on sale. And basically what ends up happening, nickels get discarded you get to buy for 3 cents. As opposed to, now you could argue that it's costing 27 pennies to buy a quarter. Maybe more than that. And not to say that it's ever going to be exactly at 25 pennies to a quarter. I'm not saying that, right? There's always some distortion away from the quarter. The events over the past, so literally as I stated on the most recent video that I posted to the Substack, which was March 1st, was one that was on delay, because I told the stable, I'm like, it's fine as long as interest rates are stable, and literally I jinxed it, and interest rates moved almost immediately. The low was around 4.18 for the 10-year note future. It is today 4.61, 4.6 and a half. And that in bond market world is a tremendous move. So let's just talk about this a little bit more before I go to actual markets. So, I don't have a good existence, because what ends up happening is when I read in the press, I see some ideas and simplifications, and there's oversimplifying, making it seem like overly easy. It's not that it seems impossibly hard. In fact, it's so watered down that what ends up happening, they've cut meat off the bone. One of those is, well, am I supposed to be checking my balance every day? Am I supposed to be making modifications every day when it's volatile, etc.? And the answer, overwhelmingly, if you read in Personal Finance or Wall Street Journal, etc., is no. But I would say that is no star. Okay? And it's here in these pictures. Because at no point do you hear in Jay's corner that the distance between here and here is defined by the same amount of time. Nobody said this is a year. Nobody said this is a month. Nobody said this is a week. Nobody said this is an hour. Right? If anything, what I would say is, and the same thing can be said of here. It is the weakness here. I'm not going to tell you that. This is a weakness of this graph, which is that if I could have my way, and I don't know how, I'm not great at videography and manipulation, but what I would have done is show you different, like where their relative shapes are different. But what my point is that hopefully people can see the mouse, that the node here, meaning that the place where these are intersecting, it looks like they're equal distance of time. That is not precisely what I would say at all. In fact, what I would be doing is thinking to myself, when do I look? When I notice that this curve starts being flatter, right? In other words, yeah, if everything is here where it's narrow and the amount of variability, standard deviation, volatility, whatever up and down, whatever terminology you'd like to use, when it's narrow, it just doesn't move that much. So as a result, it's not that, this can go on for, a year. But what I'm saying is what you've had an extreme move, and then after the extreme move, now the curve got flatter. Now we've got to start paying attention. Have to. Right? And which flies in the face of, which is very different than the article that says, be sure to check in and call your broker once a year. I'm like, no, I would say it. Be sure to check in when you notice that stuff is widening out. This meaning that this curve here is becoming flatter. Now, the fact is that comprehensive financial planning clients, we are watching this for them, right? Meaning that we have a very good feel in advance of what happens here if this stuff starts moving around, right? We're not going to let it go down to here. Otherwise, we would have put our hand up and started banging on pots and pans. But not because they're going to run out of money, but because of other things like sense of comfort, worry, stress. Right? That even objectively, the person with tons of money, let's call it $10 million, yeah, that doesn't mean they're going to like it, I promise you, as I said, right? They didn't get to that amount by being worry-free along the way. That is not what happens, right? I think people understand that. My point here is that for people who are worried to start, is this the time to look? I don't think that there's any question. Now, by that same token, I'm going to give you many, many different perspectives in the next few minutes in the next segment. But now still is time to look at these other structures and, buy a new, there's life insurance here, for example, with riders that are long-term care. There are long, complicated videos here on the YouTube channel, for example, on the YouTube channel where I discuss complex financial products. Again, this is not about the facts of me flexing to say I know about all these different products, but really what it is try to explain the function. The function, meaning if you want money to play a particular role, is there a product? The answer is yes, if you understand and define what the role objective is. Okay, and you need to be able to articulate it, to tell it to me, to send an email to say, and then if it's too vague, you will get 75 follow-up questions. That's too vague. That's too vague. What do you mean by this? What do you mean by that? And then you decide based on price, whether that fits inside of here. That is the correct order of operations so that you can deal with the resources you have given inputs that you do not control. Okay. That, of course, is not why I woke up at 6 o'clock in the morning and why I, continued on to stay up now 11 o'clock, right? But instead, what we have is, the following. So here is the market live now. There it is. I will try to switch us over. There we go. Getting better at videography, right? So what this means here, and here's the things to watch for me. Of course, I'll start up here, right? This is now the reason that you're paying attention, the reason it is correct to pay attention is this parameter now got very, very complicated. This, again, is not only the location where the Federal Reserve is, talking about monetary policy, and that's where it shows up. That is no longer it. That is the one, assuming everything else is calm, then this. Okay. Except now, the number of different inputs in here that we haven't talked about, that don't get much attention, are now in play. I mentioned it before in the prior video, and now you can see it here. These are not small, right? This used to be 1.26. This used to be 1.08. These are big moves. This is entire economies switching from their currency to dollar. Right? They don't care about your 50 shares of Boeing. Right? Irrelevant. So now, especially with the Middle East, right, this is predictable, right? Meaning that when my master's watching was interrupted on Saturday to say that there had been drones in the air, this would have been the very first spot. Almost certainly, which is flight to US dollar away from the countries that could be most closely affected. You could say the United States most closely. We're not geographically there. Let's not talk about war. It's the one time that my mother would say, I don't remember, when I know that her nose grows like about this long, right? She definitely remembers. She just does not want to say it out loud. So this here, back to the story, which is that these inputs here, and the 10-year are big. These are very important, right? Which is that this is because from there, then they're affected. That has to then do with what's going here in equities. So my point here is that when this happens and things start moving around, that two things. Number one, by no means does this mean that you should be a hero and try to buy bottoms and sell tops, right? You're going to get it wrong. Professionals get it wrong. A lot, right? There are people who literally, they do nothing all day than trade this single security. That's their full-time job, right? And you can watch their videos. I think I've seen it. Try Futures Trader 71 on YouTube, right? That's professional. That's how the professional market does it. Like as close to 0% probability that he's making it up, right? And oh yeah, by the way, lots of his techniques will look a lot like this. Lettuce. A lot. How he's measuring markets, how he's measuring in and out points all day, every day. Looks a lot like his analysis of this graph. A lot. So there's a linkage between Jay's corner, what I've been saying about Medicare, your likelihood of requiring incurring health care costs, how much it's going to cost to hedge that away, how much, and then all the way to something that looks like where's the stock market, and the stock market, and actually this instrument being the most liquid, which actually the professionals are trading on a minute-to-minute basis based on this framework, ultimately. And I don't mean to be demeaning or minimizing that, right? I know that's the watered down version. So I'm fully aware of that. I want people to understand that there's not a different contraption. There's not a different, framework here, right? We are looking at probabilities. We're looking at likelihoods, and then the financial impact to people. It just so happens Futures Trader 71 is looking at one specific thing. I'm looking at many, and then the combination of those many for somebody's financial well-being. Household net worth, household net being, retirement planning, financial planning, those types of things over time. So, a couple of things here is I don't usually talk about line items, but I talked about it when I talked over here, when I mentioned the fact that, and I'm going to shut this stuff down, right? When I mentioned this spreadsheet, when I mentioned this complacency kills, that here AI stocks are distorting stuff. And so what I meant by that is because of that, what we had is some, like, as most people know, NVIDIA, right, to the moon. But it's now 974, which is this column here, 52 high. That is 974 from the high down to 860. So there's a buyer and seller at every price. That means as somebody bought at $974 a share. They're now down to 860, which is what, 110 out of 97? Right? They're down basically 10%, which is a lot more than the averages. And you can see actually that reality is you can see a bunch of different things. They shouldn't be doing that. But you can see 430 Microsoft, 430 down to 414, $16. Not nearly as much, but you can see the highest flyer. And let's just take a look at ARM. ARM is another AI related company. Right, 164 down to 120. Now it's a much smaller company, right? So that's why it doesn't get many headlines. But you can see this is an enormous company. What can you glean from this? And now you can see how tough it is. I can easily defend many, many conclusions here. On one hand, we've got the third largest security in the NASDAQ up here. And yet the NASDAQ, for example, is only 442, 440, 16 out of, so it's 18 out of 430, 18 out of 450. So you're talking about 3% from the high? Not very much. So what I'm saying is if you took this one out, which was the third largest, and it's down by 11%, that means in order for the average to be only 3% down, the rest must have done pretty well. Which tells you that even with the volatility, even in the face of this fact that interest rates are this much higher, that equities have been very, very resilient, which is why I'm not necessarily in the camp of the world is going to, the equity market is going to crash. We just don't have, even in light, because if I told you with no other facts that the 10-year note went from 4.18 to 4.6 and the pound and the euro are this much weaker compared to the dollar and stocks are down 2-3% on average, I would tell you, wow, that's like incredible. And like I said, this is not me saying, oh, the market's wrong. The market's never wrong. That's the clearing price reporting back to you where the price is, right? The market's not wrong. Its reaction may be delayed, in other words, but it's not wrong per se. We are a price taker always. So you're an observer of the results. And as a result, what I'm saying is, on one hand, you could say, this is too high. You're infusing some judgment here. My actual observation is, this is awfully resilient, meaning someone is buying. I'm not going to get a memo. No one's going to send me, an email saying these are the parties that are continuing to buy here, even though everything here tells you that you should be selling and that there should be a lot of volatility, a lot more volatility in the world. And equities don't like volatility. As a result of all of that, then you see like a crash in the absence of a crystal ball. The answer says that the evidence doesn't seem to be there. Now, where can I be wrong? And this is a very important fact, right? I mean, I've pointed this out in many, many cases, right? I'm wrong when I look at that screen like 360 times an hour, easily, right? In other words, this is not like I think that it's going there and therefore I'm going to be right. Again, if that were the case, nobody needs a diversified portfolio. Okay, but the issue here is, okay, so let's just say up here it means on the scenarios that I'm right, and down here is scenarios where I'm wrong. Okay, there's a reason for having this kind of framework always. I'm concerned of the following, which is that given the degree of the movements here, given the degree of the movements here, one of these days this will stop. Given the degree of the movements here, you would have thought that somebody would have bought this security, right? In other words, if you're a flight to safety, so we've moved to dollars, what do we buy when we're in dollars? Are we buying U.S. stocks? Are we buying U.S. bonds? Usually it's bonds. To which I would say, okay, if this is the most secure security on the planet, true. U.S. government, shouldn't have the yield be lower? Which is, I'm going to be, and now what ends up happening is, as a result of an external shock, this relationship is going to be mucked up for a bit. And it's not going to resolve itself, by Friday. No. Right? We are going to be in this situation where this is going almost for sure, right? Which is that it's going to be more volatile. It was going to be more volatile when I said on April 1. That was before this past Saturday. 2 weeks have passed. And maybe you can call it luck, but no, I would disagree with that, which was that, I was simply observing the 10-year note, and I'm like, boy, all of a sudden it's started to be more volatile. Crazily enough, today, very, very stable. So while there was selling in equity, there was a bond buying. That was clear. That also means the flip side. Right? In other words, if we continue to go, and again, we continue to have to rotate Rubik's Cube, or we continue to have to look at the other side of the coin. What if you're wrong? Meaning that we have these facts, the 10-year note, stable, basically counterbalancing one another. Today. I didn't say 2 weeks, the past is that money that you had in the long bond, that's already gone. Okay, we're here today. We're here at the red arrow. Given that you're at the red arrow, now what? Now what I'd say is probably that you're going to have this ongoing tug of war, right? Because you're going to have a bid from the people who don't want to have to deal with they want U.S. dollar denominated assets around the planet. True. You're going to have selling of it because the Federal Reserve is saying, we are not in any hurry to cut interest rates. They can both be true. So now you've got this tug of war sitting directly here. Tug of war is probably the wrong use of words. Now you've got controversy, debate about the level and direction and the speed of a change of this particular line. Every day when I wake up, it's the same thing. Wake up, tell me where the 10-year note is first. It's always that. Always that. Right? Because then I'll have then from there, look at the other inputs to see how they have reacted given the 10-year note. The issue is now, reality, as I've stated in the past, that these other line items, which is foreign exchange, are even bigger than the U.S. Treasury. Right? The number of dollars being exchanged just to conduct world trade obviously dwarfs any securities market. Longer than I intended, 35 minutes here today, but that is kind of what I'm looking at. Do I think we're back to, of course, the basics here, which is, hey, be mindful. We're still having randomness that on stuff that we don't control. We are just the observer. That's an important fact, and most important to your life, to everyday people. And everyday people means that you have $50,000 of net worth to $10 million of net worth. It is still about making sure about where your pieces, your elements in this fits, because again, you don't get to exchange your brokerage statements for Cheerios. All right. On we go. It'll be a short night. Clearly, I don't expect the volatility to decline anytime in the very near future. All right. Thanks. Never fails. Never fails. I spoke for 35 minutes on and tells you that, I am first focused on the job at hand, which is this video is going to go on YouTube. So for people who have stayed, please like, subscribe. It does help the channel. I do a very poor job because you can see I've crossed so many different topics. YouTube algorithm does not naturally push out this data because it doesn't quite know, because its algorithm works on delivering niches of information. But the reality is the actual money is in the crossover and how it fits into Mr. X's spreadsheet and how the different financial components work together in your life. All right. Thanks.